This is the other thing that people have to realize, that you can look at past recessions, like you can even look at 2008 and 2009, but you have to ask yourself, how did we get out of 2009? And the answer is the Fed came in and bailed us out. They started printing money. They started to do things like that. Now, what happens? How long can a bear market last when you don't have the Federal Reserve? And I think as investors, we have to go on that assumption unless we see inflation get down towards 2%.
Okay.
And I think this would be seen. And I would say to you is like, is anyone really that worried? I mean, it's not fun to see your investment accounts down, but is anyone proverbially jumping out the window yet? No one's doing that. There's not this fear because we've been addicted to the Federal Reserve coming in all the time and just saying, we're down 20, 30%, but the Fed will come out and save the day. What's going to happen when the Fed doesn't do that? And that's going to be where the markets really panic.
Well, they
will see that inflation number stay elevated for multiple years. And so again, it's not to say that we're going to go necessarily 60% lower in the S&P, but I think you have to think that there's quite a bit of downside here in the next 12 to 18 months in the S&P. Logical trader. And part of trading is understanding human emotion and understanding that when the whole crowd, when every single person is rushing into an asset, that's usually the mark of a top. And you saw this. I mean, we saw this in 2007 with the housing market when Time Magazine featured like the home flipper on their front page. It's exactly the same thing. I mean, when you have the mom and pop saying, "Hey, this is so easy. I can't believe how much money I'm making," it's usually the end of the move. And then you look at the charts and you understand the massive move that has gone on, the double top that we saw in Bitcoin, all the factors out there. To me, it was one of those no-brainer scenarios. Plus, let's not forget that by November, when Bitcoin was topping, we knew the Fed was going to start raising rates, right? We already saw inflation spiking, and everyone was saying, listen, inflation's spiking, so Bitcoin has to go higher. But the essence of it is inflation spiking. Bitcoin was already factoring that in. Now it had to factor in the major tightening that the Fed was going to bring in. And remember, there was so much money that had been thrown into the Bitcoin market, from checks going to Americans from the government, from quantitative easing, from all the stimulus. People were home. They weren't driving to work, so they were saving on gas money. They weren't taking vacations, so they had extra money. So all that money was going into crypto or stocks. Mm-hmm. Now, all of a sudden, you get to a point where the Fed starts sucking out that liquidity. Yeah. And there's really, as I was when we were at 65 to 69,000, I would say I'm lukewarm now on Bitcoin.
Okay.
It doesn't mean I think the bottom is in, but you're right. Let's take a look at the chart of Bitcoin. This is something I want to show you guys.
Yeah.
So here we have, this is the drop on the Terra Luna collapse. And we dropped from about 31,000 and change down to about 17 and change. And so that drop was about 40+%. Now, if you look at the collapse of FTX, Bitcoin only dropped 25%. And so you could argue that FTX was a much bigger blow up in terms of institutional money being involved and kind of the earthquake that it caused, yet Bitcoin dropped less. And so to me, I take that as a signal that says, okay, it's not the end yet, but we're getting there. And so a couple of the analysis points. So number one, I looked at the comparisons of FTX's blow up and the Lehman Brothers collapse in '08, noticing again, Lehman was a bank. It collapsed. An exchange, FTX, kind of like a bank, but in crypto, it collapsed. Now, how long did the S&P 500 take to bottom after Lehman Brothers? And the answer is it took about 6 months. So then extrapolate that out and say, okay, in 6 months from now, we might be seeing the bottom in Bitcoin. And the reason you can kind of extrapolate this out is because human emotion, you could say, oh, well, that's stocks, this is crypto. But the answer is it's all the same. And the reason it's the same is because humans, you and me, we're the buyers and sellers. And does your emotion change? Does my emotion change? No, greed and fear. It's what rules the market. So you can really extrapolate that out. And the last thing I'll say is, the S&P, when Lehman collapsed, fell another 45% from that point, from that collapse, before it bottomed in March '09. In that case, we should see Bitcoin fall approximately 45% more from approximately that, breakdown level around 18,000 and change. To me, that gives me a target just below 10,000. And keep in mind that max pain is caused when even numbers are broken. You'll see a ton of stops run at 10,000. That could be the bottom when it breaks into the 9,000.
That's real cool.
I think Bitcoin is starting to get into that mode of being between the two, right? So I think what you're going to see, and this goes with the predictions, right, for 2023, where the NASDAQ and the S&P are going to continue down. But what I'm saying is Bitcoin's going to actually bottom out. and actually start to turn up in 2023. So that means it has to decouple from risk assets. And the key to this is going to be regulation. As much as everyone hated the idea of regulation in crypto, now we see an FTX scenario and everyone's saying, all right, well, you need some transparency. You need audits. You need to see the books on these players. There has to be rules where they can't take customer funds and put it in other places. And I think that's going to be the key that really starts to trigger Bitcoin's next move up, is when you get regulation, institutions will finally start to come back to invest in Bitcoin.
Okay.
Right? Before, it wasn't popular with people. Now people have been burned so much that it's popular. That means the politicians will act. People only coming on there. And I was in earlier than that, and I was feeling a little bit of pain when we were at the highs, and you know, everyone was kind of, by the way, the same emotion that you saw when Bitcoin was at its all-time highs was there in Tesla at that time. And since then, we've seen Tesla down more than 50% now. So again, I'm no longer in that short. I don't usually hold after something's fallen so much because the risk reward is no longer there. But it's certainly, I mean, that was an amazing fall. But again, if you're a trader or an investor, you have to start paying attention to the psychological signals that the market gives off. When everyone loves something, be skeptical. That at some point valuation does matter. And if Tesla's sales start to drop more and more, I mean, there are big institutions that own this that probably way surpass the retail investor. And so you have to think that at some point it continues to come down. In fact, I do have it priced to come in at least down to $135, $140 per share, which again, it's at 180 right now. It's not a huge drop. But keep in mind, if we go into a recession like I'm saying, how many people are buying, you know, the highest priced electric vehicles? In days, you know, in markets, the blue chip stocks, there was a valuation that was given around 10 times PE, right? 10 PE on some of these stocks. Apple's still trading in the mid 20s. And that to me is way too pricey, especially if we see, I think we saw their App Store actually kind of miss on their revenue numbers in their recent quarterly statement. And that was kind of their growth engine. So I do think that, again, there's more downside. In fact, if we go to the chart, one of the things, if you want to follow when the next leg down is going to start in the markets as well as in Apple, and I connect those dots on purpose because Apple is such a big market cap, there's a trend line that connects all these lows going back to 2020. And when that line breaks, it's around 136. That's when that next big fall will happen. Right now, we're trading at 144. This is the problem with the S&P 500. We'll look at the spiders real quick, is that you basically have a trend line. Look at these trend lines here. So you have the all-time high trend line from here to here to here and to here. Yeah. And we fell right off of that. And then you had this gap fill. But let's even take away that line for now. Just look at it even simpler here. Okay. And again, I'm having some issues taking that away. That's okay. But now look at the upsloping trend line on the spiders right here. And look, we've now broken below it. And this is what we call a bear flag starting to form. So as long as we stay below this area here and we don't break out above that high, that all-time high trend line, I think you got to be bearish into year end and in January of 2023. Unfortunately, it's going to go lower. There will be a key level at around $65.50 for a technical bounce. So for those of you out there thinking about a swing trade, that would be where I'm going to be looking for it, right around 65.5. I want to just show you this because I think this is such an important example of education and understanding market psychology, is that if you look at the charts were very clearly showing us that when we hit $130 a barrel, which was over here on my chart, that was going to be a high. And I'm going to show you why. So essentially we take a parallel here, we drag it over here. Oh, and bear with me as I got to get that correct. So essentially we drag it right through there. And you could see again how on this chart, if you connected the low in 09, the low here in 16, and the dip here, you got the exact high of 130, which was when Russia invaded Ukraine. And the thing is, everyone was saying, everyone, including analysts on TV all across, oh, oil's going to 200. But if you just thought about it logically, you had central banks across the world hiking interest rates. And when they're doing that, what are they doing? It's slowing the global economy. Yeah. So again, you take the oil that Russia produces even off the market. And we know it didn't end up off the market, but that's not even close to the lack of demand or the demand destruction that we were seeing from all these rate hikes. And people have to understand that. Let me give you 5.5 level, and I'll just show on my chart real quick here where I'm getting this level from. Again, you basically just drag this trend line across, and you can see going back to 2019, these pivot highs coordinate with these lows, and it's right around that 65.5 level. So on a technical basis, it looks like we could get there as early as next week. And then I think you do see a bounce as you see this reopening kind of trade in China. lows. As soon as the Fed showed any sort of dovishness, that's when gold bottomed, right? They didn't have to cut rates. They didn't have to do anything like that. They just had to show that they weren't going to keep hiking by 75 basis points. Gold has surged up. It's hitting some resistance right here at around 1800. I think in the short term, it's going to break through there. And I think you'll head up to about 1900 and change. In 2023, you should surpass the previous all-time high of around $2,070. And I actually think you have a good shot of making a move towards 2,500 in 2023.